This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Kristina Hooper joining us this morning. Kristina is Managing Director, U.S. Investment Strategist, and Head of U.S. Capital Markets Research and Strategy with Allianz Global Investors. Welcome, Kristina.
Thank you so much for having me.
Kristina, maybe we can begin with you giving our listeners just a brief outline of your background and your involvements at Allianz.
Sure. So in my role, what I do is provide financial professionals and their clients with updates on our macroeconomic outlook, our overall financial market performance, market trends, economic trends, financial planning concepts. So I spend a fair amount of my time doing research and another good portion of my time out presenting to different groups and being in the media. Of course, a topic that has really captivated us for a number of years now is financial repression, because of how it has reshaped risk and reward profiles for different asset classes and really has changed the investing landscape. So I have to tell you, we have been beating the drum on this topic for a number of years, and that's been a significant portion of the presentations that I've given and the work we've done.
I appreciate the fact that you brought some slides with you here this morning, so it really allows us to put some structure into this. And I wonder if we could begin with you just taking us through these slides. I think they crystallize the fact that Allianz has been at this for, well, at least I started noticing in 2013 some just dynamic work. So it's been a while, if not longer.
Well, thank you so much. And so let me actually start by mixing it up a little and taking you to slide 4. And because that's really where our story begins. After the global financial crisis, the United States and other developed nations found themselves in a fairly precarious predicament. Very high debt levels, and as you can see in this chart, we showed debt to GDP levels. They'd increased quite significantly for a number of developed nations, including the United States, while at the same time they've actually come down for emerging markets countries. And so at the onset of the global financial crisis, countries were really faced with a dilemma in terms of how to handle high debt levels and low or no growth. And the United States, of course, was in a pretty significant quandary. Now, to understand what they did and the decisions they made, it's helpful to have a little context around this. So if I could just move you to slide 2, what you see is how globally governments have been able to get out of debt in the past. There really haven't been many options. The first and, of course, the most optimal is laissez-faire growth or organic growth. Now, that's, of course, the best solution, but it's hard to come by. One example of this is emerging markets nations in the 1980s and 90s. Those countries really had some competitive advantages that made growth possible. However, it's really not something that's available to many developed nations today, and so it's not been an option to help really make any kind of significant dent in deleveraging. The second option would be fiscal adjustment or austerity. That certainly can help countries get out of debt, but it also has some pretty significant implications. Austerity does have an impact on growth. It drives down growth, so it's a difficult pill to swallow. And in fact, what we know is that leaders that advocate a strategy of austerity typically don't last in office very long. And a perfect example is Nicolas Sarkozy, who was voted out of office because he was viewed as the pro-austerity candidate.
I would say the bodies are all over Europe.
Absolutely.
Very few Maybe the UK have survived with it as a strategy, but then didn't implement it anyway. So I couldn't agree with you more.
And I mean, I would say Ireland may be the one case where austerity has worked, but it has not come without some pretty high costs in terms of housing prices having fallen dramatically. There had been a significant amount of emigration out of Ireland as a result, so it was not an easy pill to swallow, although Ireland did, and they did it quite successfully. Another option, of course, is default or debt restructuring. This is essentially about lenders taking a haircut or getting out without having to essentially pay their debts. Perfect or probably one of the best known examples of debt restructuring comes from Latin American countries in the 1980s. They took out a lot of debt when oil prices were higher. When they came down, they had trouble paying their debt. Luckily, the United States came in, gave haircuts to the holders of that debt, and wrapped them in a U.S. guarantee, hence the name Brady bonds, after the Secretary of the Treasury at the time, Nicholas Brady. But there's no one who certainly is available to come in and take U.S. debt and put a wrapper around it that makes it more attractive and give our debt holders haircuts. So that's not really an option available to us. Of course, default isn't. Think about what happened just a few years ago when our debt was downgraded one notch. So that's not possible. So essentially, the least dirty shirt is financial repression. We can use it to get out of debt, stimulate growth in some cases, and luckily, it's not something that's voted in by a legislature. In fact, elected officials aren't even involved in the decision-making. It's a group of central bankers. So from many perspectives, it is the most appealing way to get out of debt.
Now, this is a well-documented macroprudential strategy, but and I fully agree with your comment on the politicians not even beginning to understand this, but is it a formal policy in your mind between the central bank and the U.S. Treasury in the case of the United States? As a forward-thinking policy that is actually being implemented in an organized fashion?
It is not. And certainly we won't find any mention of it in FOMC minutes. But clearly there has to be an understanding on the part of central bankers that high debt levels could be very significantly impacted if rates were to go up significantly. So I think there's certainly an understanding of it, but there is nothing that is spoken or written about this.
Fair enough, because clearly they understand what negative real interest rates really mean. They understand the combination with inflation and what that means to the real scope of the national debt and being able to pay it down or to be able to keep it under control. Is that fair?
Absolutely.
Yeah.
And so really financial repression, if you look at slide 1, is simply government policies that seek to capture domestic savers and underpay them. That was the meaning given to it when the term was coined by two Stanford economists in the early 1970s. And that's really what it does. Obviously, monetary policy plays a very significant role, but regulation helps in that capturing part in order to underpay domestic savers.
Does it not force savers to take on much higher levels of risk? And really, isn't it a severe penalty to savers and pensioners to the benefit of those who are highly leveraged or with large debt? Is that a fair statement?
That is completely fair. It is a stealth tax. Yeah. I like to think of it as the financial form of carbon monoxide because so many don't even realize it's happening or the complete ramifications of it. If you move on to slide 5, this is really interesting because it gives a historical perspective. This is not the first time we've made a foray into financial repression. And also, this isn't the first time that we've had very high debt levels in the United States. If you go back to the post-World War II period, we finished World War II and the Great Depression with a very high level of debt. We were a little bit over 120% gross debt to GDP. so actually a worse predicament than the current crisis that we find ourselves in. Now, what we did to reduce that debt was, of course, financial repression. We took rates very low. Short rates were held in that 0 to quarter percentage point range for several years. So not very different than what we saw this time around. But the key takeaway from this slide is that even though we were in an environment of financial repression, and I would argue that tailwinds were far better in that post-World War II period than they are today, it still took a long time to delever. In fact, if you turn to slide 6, what you see is a brief comparison, essentially a cheat sheet of the post-World War II period in terms of financial repression with our current period in terms of financial repression. And really what's key is that in terms of monetary policy, we've had a very similar strategy with very low short rates. What's different, what's markedly different, is the unconventional monetary policy. In other words, quantitative easing, phases 1, 2, and 3, Operation Twist are all very different and extraordinary, arguably experimental. Keep in mind that QE was only an academic idea in the 1970s. Tobin came out and argued that had we utilized QE in the Great Depression, we would have gotten out of it sooner. But up until Japan decided to utilize it, QE in the early 1990s, it was just an idea. But really a sign of just how desperate the United States was and other countries are in the wake of the global financial crisis, we went essentially whole hog into quantitative easing. And that's really the difference. The other difference, of course, is that we have demographic headwinds this time around, whereas we had demographic tailwinds the last time around. That just suggests that we're going to be in it for the long haul, because demographics mean we're going to continue to have a lot of stress on the federal budget. Entitlements have gone from about 31% of total government spending in 1982 to about 62% in 2012. So a big, big difference. And again, that suggests we're going to be in a high level of debt for a while. It's not going to be easy to delever, and we're going to need to be in something of a financially repressive environment for some time to come.
I just interviewed Professor Lawrence Kutlikoff at Boston University, and he presented last week before the House Banking Committee on the size of the fiscal gap, and he had 500 economists, 15 Nobel laureates, at least these are the numbers he gave me, that signed off that, in fact, the real fiscal gap that should be reported to the public is in the area of $210 trillion. And I think even some of the other numbers are at 84 trillion. These are staggering numbers of realistic size of unfunded entitlement programs that growth may not be able to offset. Do you have any views on that? Do you think those to be accurate?
Well, we don't have any specific views on that, but what we'd say is that we do think the fiscal strains are significant on the U.S. government. And for us, it's all about what that means for monetary policy and what kind of environment we're going to be in, perhaps for decades to come.
I couldn't agree more, but you think it's still manageable?
Well, it has to be manageable, and that's really where the Fed comes in terms of making it manageable enough by debt servicing costs. It's really interesting. If you look at how much money the federal government spends servicing its debt, in the past few years, even though our overall debt has gone up, the amount we spend servicing it has gone down. And that really is the beauty of financial repression. Consumers can't dictate their interest rates, but the federal government can, and it does, and that's financial repression.
Precisely. That's how we envisage it, exactly the same. In actual fact, by removing as many of the treasuries from the market, and that the Fed now holds, and in fact they pay, the Treasury pays a interest to the Federal Reserve on those bonds that are being held. That money is then returned to to the U.S. Treasury as part of the monetary policy within the country. So effectively what we have, as long as that debt is never returned out, it is and stays on the books of the Federal Reserve, it's been removed at zero cost to the U.S. government. That's simple accounting. And it's more, this is more than a stealth tax. This is a very clever way of helping to bring the current size of the debt under control. And we've had Richard Duncan on, and Richard has has done a tremendous amount of work on specifically this, showing exactly the numbers that support that. Anyway, I've interrupted you, but we couldn't agree more with your points.
No, this has been a really great dialogue. Let me turn you to slide 7, because this is really where we find ourselves today. We've dialed down, to a certain extent, our financial repression in the United States. Not by much, but we've ended quantitative easing. So we are normalizing monetary policy. And that presents a really interesting scenario. The U.S. economy has made something of a substantial recovery. So the Fed has ended QE. It's now poised to begin hiking rates at some point. But other countries, the majority of countries, including some EN countries, are now easing monetary policy, and in many cases they're becoming far more accommodative. So we're going to remain in an environment of global financial repression, even though it's being dialed down in the United States.
Isn't this also forcing the United States dollar itself to explode higher?
Exactly.
Which doesn't help profits?
It doesn't. This divergence sets up a scenario where the U.S. dollar is rising relative to other currencies. We've seen a pretty substantial rise just in the past few months. And, keep in mind that in the past few rate hike cycles we've had in the United States, this hasn't been the case, where the U.S. is swimming against the tide. We've actually been raising at the same time other countries were raising. Mm-hmm. So this sets up a unique scenario, and as you pointed out, one where there are a lot of implications, including an impact on earnings. So we just need to keep that in mind. That's part of the unintended consequences when countries start to dial down financial repression in a global environment of financial repression.
See, this is one of the bigger differences from after the Second World War, where we implemented these policies. And as you correctly point out, one, we are on a fiat-based currency system today. Back then, we had restrictions within the gold standard, or at least the practice of maintaining the growth of the balance sheet. So what's happened here, in my mind, and I'm simply a practitioner and investor, is that we've had $9 trillion of carry trade of cheap U.S. money that's flowed out, and about $6 trillion of that has landed in emerging markets and has created an explosive increase in supply. That is, when quantitative easing has built up demand, brought forward or future demand forward, but it's at a certain level. Supply is matched up, but both of those are at elevated levels. And to maintain that, you got to bring more demand forward. Well, so soon as it slows, us in the manufacturing world immediately cut back on inventories, commodities drop, and I think that's what's unfolding now. Is that a fair observation?
That is, and I would add another complication, which is that when we were really at the vanguard of reducing rates, when I say we, the United States, and becoming extraordinarily accommodative, what we did was we encouraged companies in other countries, particularly in the emerging market space, to take out debt denominated in U.S. dollars.
Exactly.
And that's also creating something of a crisis now because it's becoming harder and harder to service that debt. Of course, the Bank of International Settlements came out with an interesting paper on that recently. So that's another, I would call an unintended complication of what's going on.
And as the global economy is slowing, and it is clearly slowing, it puts a bigger and bigger burden on these suppliers, these emerging markets, to pay that debt that's now dominated in the U.S. dollars, because, the cardinal rule of a carry trade is to borrow in a currency that's going to devalue. And I think people felt the U.S. dollar was going to devalue, and they're on the wrong side of a very, very big wave.
Exactly. We come to this point now where investors are in a quandary. In many ways, this is a much more complicated and difficult environment than really the past few years, the post-global financial crisis years. where it was very easy to move out on the spectrum and be rewarded because the Fed had really redefined risk and reward for different asset classes. So we've got several headwinds, and if you look at slide 8, we've got concerns about preserving wealth and how you do it after a 6-year run. We've got concerns about income and where do we find income in an environment where rates could potentially be rising in the United States at some point, but certainly nowhere near where they were 10 plus years ago. And then we also have one additional headwind. You had touched on the fact that growth globally is decelerating. We think we're in a relatively low growth environment, and we will be for some time. Where do we find those pockets of opportunity, of growth, at a level higher than that of the overall economy? We need to do that as well in order to meet long-term goals.
This is going to force U.S. investors to be much more diversified globally as they look for real growth that's available out there, is it not?
Absolutely, because what you see is an environment that's also changing rather rapidly. So they are going to need to look for opportunities and dodge risks all over the world. And our expectation is that we're going to see more volatility going forward. We're also going to see more rotations in leadership among different asset classes, within asset classes, among sub-asset classes. For example, in global equities, we could see some significant changes in leadership by market capitalization and region within the course of a year. So this is not an environment where we can set it and forget it, so to speak. We're going to have to be on top of all the different changes and risks that occur. We certainly continue to have macro events play a very big role in the fate of different asset classes, but add to that the fact that correlations are going down, particularly among U.S. equities. So all this spells is the need for active management, both in terms of asset allocation, but also in terms of security selection within asset classes. So this is a far more complicated market environment. Just think about the dollar and how it is impacting earnings for U.S. companies. It would be very difficult to be an index investor in this kind of environment. One needs to be very selective about the names they own. And you can say the same thing about oil. Think about where oil has taken different stocks, different countries, and certainly it's really creating a lot of downward price pressure on Latin America equities. But if we were to see some kind of turnaround in the price of oil, not just stabilization, but an increase, we could see markets move away from Asia EM and move back to Latin America EM. So lots of changes going on. Certainly macro events are dominating, but we're also seeing fundamentals make a difference again.
There may be a chance that we're moving more to value investing than growth than we've traditionally seen over the last 15 years?
Actually, we think that we could, in the course of a year, see shifts from value dominating to growth dominating and back to value. That's the kind of very unusual environment we're in with so many different market forces at work. And I think the overall message is that global financial repression is still alive and well and will be for some time to come. And so for those investors who are risk averse, they can't stay in cash. They can't assume that because the Fed seems poised to start raising rates that things will go back to normal. And a perfect example of this can be found on slide 9 in terms of really illustrating how risk and reward has been changed, truly altered by financial repression. At the end of 2007, it took about $2.9 million in cash to generate $100,000 in income. By the end of 2014, it took over $200 million to generate that same $100,000 in income. Interestingly, over the same course of time, what we saw was that it actually took a little less of an investment in stocks to generate that same $100,000 in dividend income. So things look very different from an income standpoint, but they also look very different just from a risk and reward standpoint. So investors really do have to think about how they can meet their long-term goals. Slide 10 underscores the importance of dividends in virtually any investor's portfolio going forward. Dividends not only reduce volatility, they're an important source of an important complement to capital appreciation when it comes to total return. And in fact, we'd argue that our expectation for this year is that we're going to see fairly anemic stock market returns. So dividend income could play a very important role in total return in this kind of environment. We could see that for several years to come. We also need to be very concerned about what I call the collateral damage of financial repression. You can find that on slide 11. It's capital depreciation. Now, that's hard to even imagine because of the bond bull market we've been in for so many years. But that's because we are on a very different trend from the early 1980s Volcker years to where we are today. And we are now poised to start moving in the other direction. It's not to say that we're going to necessarily do it very quickly. In fact, our expectation is that it could be a very slow rise in rates going forward. But what we do know is that when it happens, it creates depreciation. And in fact, if you look at the lower chart on slide 11, what you see is exactly what happened to a $100,000 investment in the 30-year Treasury during the taper tantrum. That $100,000 in April went down to about $83,000 by the middle of July as a result of the taper tantrum. So we can expect that kind of depreciation going forward, of course intermittently, but certainly creating far more volatility than we've seen in the past when it comes to treasuries. That's not what investors expect. And again, this is part of the collateral damage of financial repression. So slide 12 really advocates for looking beyond traditional fixed income for income. So we need to look for alternative sources of income, particularly ones that hold up well in rising rate environments, inflationary environments, because that's what we need to be concerned about going forward. Finally, we need to have pockets of growth. We need to look for those areas, those parts of the economy that are growing faster than the overall economy. And I can't stress enough how much we think active management is going to play a role in that. We're seeing pairwise correlations going down. That's been our expectation since QE ended, and the Fed is poised to normalize monetary policy. So I would leave you with slide 15, which is all about active management and being in a multi-asset solution. We don't think that there are any clear winners in terms of asset classes or sub-asset classes. Certainly we think stocks are going to do better than core fixed income, but we also recognize the very changing nature of our current environment, rapidly changing. And so to have an actively managed multi-asset solution enables investors to pivot, to turn, to capture opportunities and avoid risk. So that's really the message today is financial repression has created a lot of unintended consequences. There are still opportunities out there, but we need to be very careful in this kind of environment.
This is going to be, it's always difficult as an investor, but going forward for the retail individual investor, even accredited investor, you're going to need a very sophisticated manager, active manager, helping you looking at things on a global basis, without question. And I would argue that even pension plans and a lot of funds themselves are going to become a lot more sophisticated in this environment. Am I overstating that?
No, they're going to be forced to.
Yes.
This is a very complicated environment.
Key is it is going to be low growth. Financial repression is here to stay for the foreseeable future because of the size of the debt. This is the reality. And it's going to be macro-driven with macro events, which is going to be volatile. It's not going to be for the faint of heart. But if you've got it well diversified, well balanced, and active, you got as good a chance as any of getting through this and maybe even growing some of your wealth. Let's hope anyway on this. Kristina, we have to break. Great job. Really appreciate it. You covered an awful lot of ground here in a very short period of time. I'm sorry to have interrupted you, but really appreciate it. Thank you. Have you any closing messages you'd like to leave with our listeners?
Actually, I couldn't have said it better than you did just now. So I think global financial repression is here to stay. We need to be prepared for it. It's a little bit different than the last few years. It's far more complicated. To be actively managed solutions, being very, very well diversified globally, that will make the difference for investors.
Can you tell our listeners where they could get more information from Allianz? I know you have websites and you have some very good ones on financial repression, but is there anywhere where you could direct them to help them do their own due diligence and their own research?
Sure. Well, certainly our website is a great starting point. And that's www.allianzinvestors.com. Beyond that, just Googling financial repression, I know also your website has a lot of great information, is a great starting point.
Well, thank you very much. Well, it's going to be an exciting time this year. I hope to have you back sometime this year to pick this up again, because as we said, it's going to be around with us for some time. So thank you very much, Kristina. Much appreciated.
Thank you.
Thank you very much. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.